Joining me now is James Demmert. He is the Chief Investment Officer at Main Street Research. James, thank you so much for joining us. I think it's obvious that market psychology has been dominated by Mr. Trump's trade war. The big question, one at least, seems to be on the degree to which this tariff policy has undermined confidence, not only in the American economy, but in risk assets as well. What is your sense right now of where we are?
Good to be with you again, Doug. And our sense is that the market was way overdue for a normal correction, which turned into something much worse when those tariff announcements came out, much more dramatic than anyone expected. And that's why you saw the S&P 500 tumble to what level of 5,000. And that did spark a lot of fear. And, you know, in our view, probably the kind of bearishness that you see at market bottoms. So since we bounced off those levels, there is definitely an uneasy feeling amongst investors. I think a lot of people are worried that we're going to go down to that level again and maybe much lower. In our view, the worst is probably behind us relative to the tariffs anyway, in the market level, but we may retest those levels. But you know, most importantly here, I think investors should recognize from wherever the market gets stable and starts to go up again, it's probably going to be led by a different group of stocks than what we saw last year and the year before.
What is your sense about recession and whether or not we're going to have an inflationary shock and maybe a combination that leads to stagflation?
You know, stagflation is really the buzzword, and we think that because it's so talked about, it's probably a lower risk. And then there's always the possibility of a recession. And in our view, when we really look at tariffs, I think this is important for investors to consider, even with the extreme level of tariffs pre-negotiating, that would shave, in our view, about 0.75% off of GDP. Now, right now, we're growing at 2.5% annually. So that takes us down, let's just say, to 1.5 or 1% growth. It really doesn't take us to stall recession levels. So our view is that, yes, this will slow U.S. growth, but not to recession levels. And even if it got near there, Doug, let's say the labor market really starts to crumble, the Fed has got more than enough ammunition to do things with the balance sheet or cut rates. And I think they would, to avoid any sort of recession. So that's why I think investors want to be careful here of, you know, getting completely liquidated from stocks, because the idea of recession is probably out of the game as far as we can see.
So you're talking about leadership changing, and I'm curious what that looks like. I mean, are there areas of the market now that you feel are more attractive, let's say, than they were prior to this corrective phase that we were in?
Yes, and you know, I consider it a new world order. You know, you've got tariffs that are not going to come off certain industries and sectors, and I think those are the things that investors need to avoid. And that where it's really acute is in the industrial stocks, such as Caterpillar that sells products all over the world, or the autos. I'm sure those are going to be very difficult. But if you think about it, at least in the U.S., and we're also big advocates of investing outside the U.S., and that's another thing that'll be different than what we saw in the last couple of years. But in the U.S., you look at companies like in the financials, they are pretty much immune to tariffs, and that would be anything like a J.P. Morgan or Berkshire Hathaway. Look at companies in the telecommunications space like T-Mobile. There's a lot of companies out there, or McKesson in the drug industry, that are completely not affected by this. So unlike some of the bad markets you and I have gone through, where it's a full-blown recession, everything falls, we think this is really a tariff-related situation. And if you're selective, you can find companies that will benefit or do fine through this, and that's kind of what we're seeing. And then, of course, we think investors should be allocated outside the U.S., which I'm happy to chat about as well.
So before we go there, I'm curious to get your sense on the period of time where the market can tolerate a level of uncertainty as these negotiations get worked out. What's interesting is whether or not there's a point when the passage of time becomes problematic, when no resolution has been brought about.
I'm not sure. And one of the things that I would consider is you look at it as a market of stocks, not a stock market. During the last, let's say few weeks, you see companies like McKesson acting great. You see companies like Netflix, which reported obviously tonight and had great numbers, and stocks up 6% in the after hours. We think that is a microcosm of the next 6 months if there was still uncertainty. You've got to be not a passive investor. I don't even think an index investor, but be maybe a stock picker, which is kind of our kind of market. And there are great opportunities because a lot of these stocks that are immune, as you know, have been sold off pretty dramatically, and that spells opportunity to step in. Yes, it takes courage when the news in general is so negative, but if you look at some of these businesses, they're pretty much immune to this, and they're presenting great opportunities.
Okay, so let's circle back now and talk a little bit about the opportunities that you see offshore. Talk to me about Asia first. Which markets or jurisdictions do you favor?
Well, we like developed markets because of the liquidity, particularly when you're in an uncertain world. So that draws us to Japan, it draws us to China. And I know some people think, well, gosh, China, well, that's right in the crosshairs. But if you look at individual companies, particularly those they're well developed and have liquidity, like BYD, the electric vehicle operator, they don't sell those automobiles in the U.S., but they have significant market share in China and in Europe, which will probably continue to trade. So that's a great example there. I also would look at great companies in Japan as another way to find liquidity in great brands, companies like Hitachi. Now there could be tariff issues with some of those stocks, but many of them have fallen way further, certainly discounting whatever tariff implications there may be.
I want to get your sense as to whether or not you feel, because of this trade war that's been happening, particularly between Washington, let's call it Asia more broadly. It's not just Beijing. I mean, Tokyo was in the crosshairs as well, and the Japanese trade delegation was just at the White House the other day. Do you think this kind of, the way in which the Trump administration has approached this has damaged those relationships beyond the point of maybe a trust level that was there pre-tariff?
I do. And I also think that it's created a distrust amongst investors outside the U.S. And I think that's something as investors in general we want to consider. What is the excitement about investing in the U.S.? I think that shine has worn off. And I think that exceptionalism that people talked about may be a thing of the past while this goes on, at least.
Are you fully invested right now, or you're sitting on a little bit of dry powder?
We're about 20% underinvested, and we're using that as an opportunity to find value in the continued volatility. I would expect, though, that we'll probably be fully invested over the next coming weeks. Probably not months. Okay,
we'll leave it there. James, thank you so much. James Demmert there. He is the founder, also the CIO at Main Street Research, joining us here on the Daybreak Asia podcast.